Qualcomm just posted earnings that beat expectations, reporting an impressive $3 in adjusted EPS on $11.27 billion in revenue. This performance surpassed analyst forecasts, which had predicted $2.87 in EPS and $10.75 billion in revenue, showcasing the company's strong operational capabilities in the fourth quarter of fiscal year 2025. However, instead of seeing a positive market reaction, the stock fell nearly 5%. This unexpected decline prompts the crucial question: why did investors react negatively despite such strong financial results? The answer lies in a significant one-time financial event that overshadowed the underlying performance. The primary reason for the stock's dip was a massive $5.7 billion non-cash tax charge. This substantial charge effectively flipped the company's otherwise positive results into a $3.12 billion net loss for the quarter. It's important to note that this was a non-cash item, meaning it didn't impact the company's immediate cash flow, but it significantly altered the reported profitability. So today, I'll break down what really happened behind these numbers, examining the nuances of Qualcomm's recent financial report. We'll explore whether this current downturn is merely a short-term dip, a temporary setback influenced by a one-off event, or if it presents a long-term buying opportunity for astute investors looking for value in the tech sector. Despite reporting strong revenue growth, with a notable 10% increase year-over-year, Qualcomm stock sold off harder than the broader tech market. This indicates that the market's reaction was not solely based on the company's core business performance, which was robust, but rather on other factors that influenced investor sentiment. To put Qualcomm's stock performance into perspective, the broader tech sector fell by 1.82%, and the S&P 500 dropped by 0.88%. In stark contrast, Qualcomm slid between 3.46% and 5%, clearly demonstrating that investors reacted specifically and more intensely to the impact of the non-cash tax charge, even though it did not reflect operational weakness. Qualcomm easily beat EPS expectations, delivering an adjusted EPS of $3, which was well above the forecasted $2.87. Furthermore, the company reported revenue of $11.27 billion, surpassing expectations of $10.75 billion, marking a significant 10% year-over-year increase. These figures highlight a strong underlying business performance. These are undeniably strong numbers, especially when considering the challenging market conditions. Smartphone demand remains uneven globally, creating headwinds for a significant part of Qualcomm's business. Additionally, competition in the artificial intelligence sector is heating up rapidly, putting pressure on all major players to innovate and maintain market share. However, the positive operational results were overshadowed by Qualcomm reporting a net loss of $3.12 billion. This loss was directly attributable to the substantial $5.7 billion non-cash tax charge. It is crucial to understand that this was not a reflection of operational weakness or a decline in the company's core business activities. Instead, this $5.7 billion tax charge was a one-time hit, a unique financial event that distorted the quarterly results. Consequently, markets reacted emotionally to the headline net loss, rather than rationally analyzing the underlying strength of Qualcomm's revenue growth and adjusted earnings per share. Let's look deeper into Qualcomm's financial trends to gain a more comprehensive understanding of its current health and future prospects. We will start by examining key metrics such as margins and valuation, which provide insight into the company's efficiency and market perception. Qualcomm's gross margin currently stands at 55.43%, which is slightly lower than previous periods, indicating some pressure on the cost of goods sold. However, the operating margin showed improvement, rising to 27.9%, suggesting better control over operating expenses and enhanced efficiency in its core business operations. The return on invested capital, or ROIC, is down to 21.14%. This metric is crucial as it measures the percentage return that a company gains from capital that has been invested. While the improved operating margin suggests that day-to-day operations are efficient, the declining ROIC indicates that the company's capital efficiency, or how effectively it uses its capital to generate profits, is falling. Regarding valuation, Qualcomm's PE ratio is now 32.95x, which is considered expensive relative to its earnings, suggesting that investors are paying a premium for its future growth potential. The EV/EBITDA, another important valuation metric that accounts for debt, stands at 12.39x, providing a broader view of the company's enterprise value relative to its earnings before interest, taxes, depreciation, and amortization. This combination of a high valuation and declining earnings growth often leads to investor hesitation. When a stock is priced richly and its profit growth is slowing, investors tend to become more cautious, questioning whether the current price is justified and if there's enough upside potential to warrant further investment. Despite the recent stock dip and some mixed financial signals, analysts remain broadly positive on Qualcomm's long-term outlook. Their price targets reflect a belief in the company's strategic direction and its ability to execute on its growth initiatives, suggesting potential for significant upside from current levels. Specifically, Rosenblatt has set an optimistic price target of $225 for Qualcomm, indicating strong confidence in its future performance. Bank of America also raised its target to $215, further reinforcing the positive sentiment among institutional analysts regarding the company's valuation and growth prospects. This range of analyst price targets, from $150 to $225, suggests meaningful upside from the current price of approximately $180 today. However, this potential is contingent upon Qualcomm's ability to execute its strategies effectively, particularly in its new growth areas, and navigate the competitive landscape successfully. While Qualcomm demonstrates strong internal capabilities, competition is undoubtedly its biggest long-term headwind. The technology sector is fiercely competitive, and Qualcomm faces formidable rivals, particularly from industry giants who are also vying for market dominance in key growth areas like AI and data centers. Nvidia, for instance, continues to dominate the accelerated computing and artificial intelligence markets. Its powerful GPUs and comprehensive software ecosystem maintain its strong market position, making it a tough competitor for Qualcomm in high-performance computing and AI infrastructure. Similarly, AMD is advancing rapidly in the data center and inference chip segments. With its innovative processor architectures and aggressive market strategies, AMD is posing a significant challenge to established players, including Qualcomm, as it expands its footprint in enterprise and cloud computing solutions. Even though Qualcomm is strong in edge computing and mobile technology, areas where it has historically excelled, it lags in overall market momentum compared to these formidable competitors. This highlights the need for Qualcomm to accelerate its diversification and innovation efforts to capture a larger share of emerging markets. However, Qualcomm is not standing still in the face of this intense competition. The company is actively pursuing several strategic initiatives and partnerships to drive future growth and diversify its revenue streams. Here are its key growth levers that are expected to propel the company forward. A key partnership with Humane involves deploying Qualcomm AI 200 and AI 250 rack-scale systems, with implementation beginning in 2026. This collaboration signifies Qualcomm's commitment to expanding its presence in the data center AI market, leveraging its advanced AI chips to power large-scale AI infrastructure. Another significant partnership is with Advantech, a global leader in industrial IoT and embedded computing. This collaboration focuses on developing and deploying edge and industrial AI solutions, extending Qualcomm's reach into critical sectors like manufacturing, smart cities, and automated systems. Qualcomm also strategically acquired Arduino, a popular open-source hardware and software company. This acquisition is crucial for expanding its developer ecosystem, providing access to Arduino's vast community of 30 million users and enhancing its capabilities in embedded computing and edge AI development. The company is actively expanding its presence in the burgeoning AI PC market with its Snapdragon Elite X processors, designed to deliver superior AI performance and efficiency for next-generation personal computers. Concurrently, its automotive pipeline is strengthening significantly, with new design wins and collaborations in autonomous driving and in-car infotainment systems. This multifaceted strategy is designed to strategically pivot Qualcomm away from its historical reliance solely on smartphone chipsets. Instead, it aims to diversify its revenue streams and position the company as a leader in high-growth sectors such as artificial intelligence, the Internet of Things, and the automotive industry. Examining insider activity provides additional insights into the company's health and management's confidence. Recent reports show normal equity awards, with 7 award transactions totaling 160,180 restricted stock units, or RSUs, which had a total value of $0 at the time of grant, indicating standard compensation practices. Crucially, there has been no insider selling reported recently, which is often considered a bullish indicator for the stock. The absence of insider selling suggests that company executives and directors are confident in Qualcomm's future prospects and believe the stock has further upside potential, aligning their interests with long-term shareholders. For long-term investors who firmly believe in the transformative potential of edge AI and the significant growth opportunities within the automotive sector, Qualcomm presents a compelling investment opportunity. Its strategic pivots and technological advancements position it well for future market leadership. However, in the short term, the stock may remain volatile due to several factors. Market reactions to one-off events, like the recent tax charge, can cause temporary fluctuations. Additionally, ongoing competitive pressures from industry giants like Nvidia and AMD will continue to influence investor sentiment and stock performance. In summary, Qualcomm beat expectations with strong adjusted EPS and double-digit revenue growth, demonstrating robust operational performance. Furthermore, the company is actively strengthening its artificial intelligence strategy through key partnerships and product developments, positioning itself for future innovation. But the headline tax-driven net loss, a one-time non-cash charge of $5.7 billion, unfortunately spooked markets. This led to a temporary dip in the stock price, as investors reacted to the reported loss rather than the underlying strength of the company's core business and strategic direction. The real story here isn't just about the immediate earnings report. It's about Qualcomm's long-term strategic positioning in the rapidly evolving AI landscape and its successful diversification into new, high-growth sectors. This includes significant advancements in IoT and the automotive industry, which promise sustainable growth beyond its traditional mobile business. Considering all these factors, should Qualcomm be on your watch list for future consideration? Or do you believe it deserves a place in your current investment portfolio? Let me know your thoughts and analysis in the comments below. Your insights are valuable to the discussion.